All right, what do you make of the rebound? I mean, yesterday it seemed like the markets were kind of weighed down by some of those Jay Powell comments and also some questions about the AI trade. Why are we seeing the rebound this morning?
Well, I think you're checking both boxes. First off, Jay Powell mentioning that markets might be overvalued as being like the sky is blue, water's wet. We know nothing's cheap right now. There's not a lot of cheapness in the market, but that doesn't mean necessarily that we can't see the uptrend persist. So I think a lot of his comments weren't that bad. I think the market was reacting to him saying, look, there are dual risks out there, right? There's no risk-free path for them. They're fighting inflation. They're fighting weakening labor. But for me, the AI trade, the concerns on that, we check that box. Look at Micron, look at Baba. Like everybody's continuing to hum along here. We've had continued beats across the street on AI related companies. And for me, that just gives credence. This trade is alive and well, early innings still, plenty of legs on the AI trade.
All right, so it sounds like you're hearing and seeing a lot of things that you like. So then why is your word of the day today earplugs? What are you trying to block out?
There is a lot of noise out there, and we're kind of hitting this dearth of earnings, right? We've got a couple more trickling in this week and next week, Costco, Nike, but we're going to be kind of in a dead period for earnings until we kick back off on October 14th with the banks. I'm just telling people, maybe put some earplugs in, tune out some of the noise. The noise gets louder when there's not other events happening. So we might be reading into small secondary data points or smaller data releases being like, oh my goodness, this is a market changing event. It's probably not. So just take a step back, put your earplugs in, tune out noise. Politics has been loud, and you just really need to stay focused on your objectives, stay focused on the fundamentals, stay focused on the technicals, and not let all of this little chirping and kind of all the worry out there derail you from your plans.
All right, so what are your plans? Is your plan to continue to invest in the AI trade? I'm not saying exclusively, or are you also looking at the broadening? Because I want to get to your pick. It's Vulcan Materials. Is that a sign that you're seeing a definite broadening in the market?
Yeah, absolutely. We like tech, industrials, financials. We like some select energy and power companies. The power trade's alive and well. Vulcan Materials is the leader in the United States in aggregates. And aggregates are what is inside like concrete and asphalt. It's sand and gravel and crushed stone. So all of that road construction you see, all those annoying little cones out there, that's probably being driven by Vulcan. So they're the ones supplying that. And they've been phenomenal at their pricing. They have dominant positions across most of the major marketplaces. Often they're the number one or number two player in some of these states like Texas and California, Georgia. I also like the fact they're Alabama based, and guess what's coming to Alabama that's going to need a bunch of concrete poured? It's going to be Space Force. So I see that as a long-term tailwind to them, but we love the way that they're positioned. They're not cheap. We like to talk about right now investors.
Well, hold on, Vicki. Let's get into that for a second. So we always like a pick outside the box. It's great to see somebody pick something outside of tech. We get a lot of tech picks here on the show. But when you're looking at materials companies, there's CRH, there's Martin Marietta, and there's Vulcan. They're similar. They're not identical, but they're similar. Your pick is the one that's had the, I guess, worst. They're all performing the S&P, but the worst stock performance this year and has the highest forward PE. So why are you picking that one out of that trio?
Because of their dominant pricing. They've had a little bit of headwinds to get through, and I'll freely acknowledge they've trailed their peers on that. But I actually love their EBITDA growth. If you look at how they've been able to raise prices, so they sold a little bit less aggregate, and that's kind of been the drag on them. But they price it better, and so they've literally increased the price per ton on aggregate 55% over the last 5 years. They're going to continue to make more money and more free cash flow, and we think we're also through some of the hurdles on some of the spending. If we get lower rates, we're going to get more commercial, residential, as well as infrastructure projects, which we've had some holdups on actually rolling out infrastructure projects. Those seem to be rolling down the pipe. They're very good at winning awards. If you look at their award win rate, especially from municipalities, it's extremely high. They're increasing faster than their peers. So I freely admit that, yeah, have they beaten Martin Marietta this year? No. Do they have the potential, even though they're a little bit pricey? Absolutely, because they are the dominant player in aggregates, and that's a place we really, really love because it's where all construction is based off of. You want to build bad data centers and roads to data centers, it's going to come from Vulcan.